Right, so hopefully everybody can see the presentation on the screen, and I'm moving through to the first slide, which is a summary of our financial year results. Keith, one more, please. Another one. Thank you. So as we mentioned in our RNS release, it has been a watershed year for us at Petra Diamonds. We faced a number of challenges along with many other businesses and really the world as a whole as we navigated our way through COVID. At Petra, we also had to navigate our capital restructuring, which we're very pleased to have done with the support of our creditors. And as a result of the restructuring, together with a stronger market and the recovery of a number of exceptional stones from Cullinan Mine, we were able to generate $62 million from these exceptional stone sales and reduce our net debt to $228 million. Project 2022 has helped us to consolidate and stabilize our production and at the same time improve our operating efficiencies. And the result of that, together with a supportive market, resulted in operational free cash flow of just over $120 million against a negative operating cash outflow in our previous financial year. Other noteworthy post-year-end events, we have successfully concluded a 3-year labor agreement with NUM, which effectively is a 6.5% annual increase over the 3-year period, and it brings us some stability in terms of our workforce, which will be very positive for the business. Thank you, Keith. Turning to safety, our focus on safety, as always, is our first priority. We have, unfortunately, in financial year 2021, seen a deterioration in our lost time injury accidents and the frequency rate, and this is receiving significant attention from the operating teams on the mine and the executive committee. We have seen this increase against a backdrop of increases across the industry, which we believe is related to the pressure and stresses around COVID-19. However, we have renewed our focus around our behavior-based interventions, as you can see on the screen, and I'm pleased to say that we've had a good safety start to financial year 2022. Thanks, Keith. If I turn to our KPIs for our financial year 2021, generally strong operating performance across the piece, although our production was slightly down at 3.2 million carats. This was really the result of lower production at Finsch and Koffiefontein, and we also had Williamson and care and maintenance. On the revenue front, very strong growth in revenue, supported by the exceptional stones I've already mentioned, so 65% up at $402 million, with operational capex down at $22.5 million, and really that was a focus through the capital restructuring in conserving cash and managing our capital very tightly. And you'll see when we get to the outlook section that we do see an increase in capital as we start to develop new areas at both Cullinan and Finsch. Thank you. Touching on Cullinan, we really have had a very good run in terms of the production of typically unique Cullinan exceptional stones, and we, as you know, announced the Letla Patala collection, comprising the 5 blue diamonds that we sold for just over $40 million. We also included the picture of the 299 carat on the screen, which was also sold in financial year 21. And then we're very pleased to have additional revenue from Cullinan Stones into this financial year, being the record 39 carat blue that went for $40 million. And in as far as we can determine, a record $1 million per carat price. We also then recovered a 342, nearly 343 carat white and just over 18 carat blue diamond that we sold in a partnership for 13.5 million, and we retain 50% interest in any uplift in terms of profit in the following the sales of the polished goods. Thank you. If we look at EBITDA and operational free cash flow, you can see a very strong increase in our adjusted EBITDA, driven by better diamond market and diamond prices and the exceptional stone sales, and pleasing to see the EBITDA margin moving up towards 35%. Operational free cash flow, as I've mentioned, mirrors the adjusted EBITDA and turns around a negative outflow in financial year 2020. We are reporting an adjusted net loss after tax considerably down on last year, with a basic profit per share of 6.67 US cents, driven also by the capital restructuring that Jacques will touch on in his section. Thank you. In terms of our ESG performance, I'm not going to take you through the slide in detail, but this just highlights both the progress and focus on a number of key measures around investing in our employees for developing and training, the focus on diversity, where we've seen an increase in the percentage and composition of women, both in our employee base and also represented on the board. We've seen an improvement in our carbon emissions, partially assisted by lower levels of operations in financial year 2021, but also benefiting from improved energy usage per ton, with a strong focus and initiatives around improving our energy consumption at the mine. Thank you. Turning briefly to Tanzania and an update on the human rights issues that we've reported on extensively at Williamson, really just highlighting in this slide the key elements around our action plan. The first was in reaching agreement on a settlement through entering into agreement with Lee Day, and that's summarized there as a settlement of $6.1 million in total. We had already begun work on establishing an independent grievance mechanism prior to entering into the settlement agreement, and that really is to ensure that we are in a position to address any further allegations or claims of human rights violations through an independent Tanzanian-based mechanism, and I'll touch on that on the next slide. We've also spoken about the restorative justice measures or projects, where we have funded an escrow account to the tune of just over £1 million to fund feasibility studies into ASM and agribusiness projects, and also to address and provide medical support and a few other initiatives. We've adopted a human rights defender policy, and part of this focus is around sexual and gender-based violence, and we have an initiative to address that in addition to the various projects I've mentioned. We are using Synergy to support us in the design and implementation of this comprehensive response. Thank you. And then just a quick illustration of the components of the independent grievance mechanism. It highlights the scope, where the focus will be on grievances under Petra's watch. We are ensuring that there are safeguards and support in order for this to be a trusted solution that is safe and supported by our surrounding communities. If required, complainants will have access to lawyers, and obviously claims will be kept confidential. It is dialogue-based, so there is considerable stakeholder engagement required to build trust and support for this as a Tanzanian solution. And then importantly, it's also independent, and it is independent of WDL and PDL. It's an extrajudicial process, so it is not a legal process. And we will have it run by an independent panel of Tanzanians, and there will also be an appeals panel if required. With that, I'm going to hand across to Jacques to take you through the financial results and a quick update on the market before he hands back to me to provide an overview of the operations, and we'll then conclude the presentation. Thanks, Jacques.
Thank you, Richard, and good morning, everyone. Before I continue, I just note that Richard Hatch raised a hand. Richard, I suggest that you lower it for now and raise it again at the end. We'll have a Q&A session towards the end of the presentation, if you don't mind. Moving on then to our 21 financial results. Thank you, Keith. It is quite a busy slide, and as always, I do apologize for that, but I'll highlight a few of the items. Before I do, I just want to mention that we also today announced that the board is reviewing strategic options around Williamson. As a result, our FY21 and 2020 numbers reflect Williamson as effectively a discontinued operation, as the mine has been reclassified as an asset held for sale. More on that a bit later. Revenue, Richard touched on that, up 65% year on year. It was largely driven by a significant increase of the diamonds sold, some 51% up from the previous year, on the back of a significant inventory being carried forward from last year. As a result, adjusted mining and processing costs increased significantly year on year from $169 million to $261 million. And that's really on the back of the increase or the inventory carryover from last year, which resulted in some $82 million of inventory movement recognized in this financial year. The cash on-mine cost increased by some 3.3% only. Adjusted EBITDA, also touched on by Richard earlier, $135.4 million, representing a 34% margin and up from the prior year's 28%, recognized or delivering the $67 million restated. Depreciation and amortization, just to mention the increase there, was largely driven by strengthening rand from the previous year, with most of our assets carried in South African rand values, while Cullinan's increased production throughput also resulted in additional depreciation at that operation specifically. Net finance expenses of $67 million was largely on the back of some $54 million of accrued interest during the financial year. Our cash interest for the year came in at some $6 million during the period. This resulted in an adjusted loss before tax of $8.9 million compared to last year's $74 million. Some of the, let's call it below the line items, impairment charges, you'll note we've recognized $17 million of asset level impairment charges. $15 million of that relates to Finch and some $2 million to Koffiefontein. There's more detail in the preliminary results announced today. The BEE loans receivable, you'll note that we've released or reversed rather, a prior impairment on that, and that follows the capital restructuring earlier this year where the BEE debt was settled and some of the intercompany loans between Petra and our BEE partners were rescheduled as well. A significant gain was recognized on the P&L, some $213 million relative to the extinguishment of the old $650 million bond, again as a result of the capital restructuring successfully completed earlier this year. Jumping to the net unrealized FX gains of $77 million compared to an $82 million last year loss. That's really on the back of a significant movement in the rand. The rand closed at 14 rand 27 to the dollar at 30 June of this year, compared to 17.32 rand last year. And the impact on unrealized unrealized FX movements was largely on the back of intercompany loans restated. Profit and loss from continuing operations came in at $248 million compared to a loss of $165 million last year, while Williamson's results is reflected as $52 million of loss this year compared to $58 million last year. The $52 million loss recognized this year includes some trading results of just over $11 million loss on the back of the care and maintenance activities during the fiscal year, $21 million of impairments recognized around Williamson, as well as some $19.5 million of unsettled and disputed tax claims we have recognized at 30 June of this year. Richard touched on the earnings per share already, so I'm not going to repeat those items. Moving on to the next slide on our balance sheet snapshot. Cash at bank at $163.8 million, almost $100 million up year on year. And that balance importantly includes some $16 million of restricted cash associated mostly with our environmental funds that we are setting up. Diamond inventories reduced significantly year on year. We, at the end of June, had some 560,000 carats across the SA operations. Again, these numbers exclude Williamson. That represents some just over 10 weeks worth of production and is have largely normalized with some further improvements to look forward to should we revert back to sales only in South Africa. As a reminder, we do have currently the dual tender system where we sell both in SA followed by an export and a further tender in Antwerp, which increases our inventory lockup somewhat. Diamond debtors of $38 million was on the back of a sale closing right at year end. All of those funds were received shortly thereafter, and it's as you would recall, we have a almost near cash item in our diamond debtors. Loan notes, the movement there reflects the restructuring from the old $650 million bonds now fully extinguished and replaced by the $336 million loan notes that we currently have, net of some amortized transaction cost, showing then the balance on an IFRS basis as slightly lower than the capital outstanding. Bank loans and borrowings, again, through the restructure, we've settled our BE partner facilities in full, and $103 million is what was drawn at the end of June, with the movement compared to last year's balances largely FX related, with the significant strengthening in the rand year on year. Consolidated net debt then ended the period at $228 million compared to just under $700 million a year earlier, all largely thanks to the capital restructuring on the one side, as well as significant cash contribution from the operations, as Richard also alluded to. Just a high-level bridge and on our net debt movement, and this is specifically our consolidated net debt, moving from $693 last year down to $228 million this year, largely driven, as I mentioned, through the debt restructuring, assisted by operational cash flow of some $120 million net, broken down in the items represented on the chart. You will also note that restructuring fees of some $29.9 million was settled in full during this period, while net finance expenses accrued just over $57 million during this 12-month period. Realized FX losses of some $6 million added then to the net closing balance of $228 million. Moving on to the next slide, operating cost ended the year largely in line with our expectations. Importantly, our on-mine cash cost came in at $197 million, as you can see at the table at the bottom of the slide, moving some 3.3% year on year. And on the right-hand side, there's the explanation of the major items contributing to that move. The rand adding some 1.7% in US dollar reported cost, while local inflation, again mostly SA-based, added some 6%, which includes both our labor and then significantly above CPI electricity increases. Those were then partially offset by the variable cost impact on the improved production, as well as some net savings, including our Project 22 initiatives, which added just under 4% of net cost savings during the 12-month period. Moving on to the market, you'll note that supply is continuing to contract. The latest estimate indicates some 107 million carats in 2020, down some 22% from the previous year, 2019. We do expect that these levels will remain largely flat going forward, with some increase to 2021 expected, thereafter remaining more or less at those levels. As noted there, the closure of the Argyle mine has resulted in some 10% of world production effectively being removed. And also just noting that diamond exploration is a difficult game, and with less than 1% success rate and no major new finds since the early 1990s. We have witnessed a rebound in the consumer market. There was significant release of inventory through the pipeline, and specifically in the what we would call the midstream and downstream sectors. Strong consumer demand was noted specifically in the US and China, leading to shortages in certain polished goods specifically. We've seen capacity returning to the midstream manufacturing sector, specifically after the COVID disruptions, which was especially hard felt in places like India. Natural diamonds remain highly desirable and fighting off the threat, if I can use that word, of synthetic diamonds or lab-grown diamonds. And given the COVID restrictions and disposable income higher among certain consumers, with the lack of opportunity to spend on competing luxury categories such as holiday experiences, we are also seeing a benefit coming through in the diamond market. The Natural Diamond Council, of which Petra is a founding member of, continues to support the consumer market. And I would also encourage participants to view the link there, which is included in our presentation, with the latest campaign launched by the Natural Diamond Council fairly recently. That covers the market section, and I'm handing back to Richard for the operations update.
Thanks, Jacques. So just turning to a quick summary of the operations for financial year 2021 and a comparison with our last financial year, you can see the strong shift towards Cullinan in our financial year 2021 on the back of the record throughput that we referred to. So there is a shift in terms of Cullinan now representing 60% of our production and 62% of revenue, versus last year with Koffiefontein remaining a marginal contributor and Williamson contributing in FY 2020, but not in 21. If I briefly touch on each of the operations, starting with Cullinan, thanks, Keith. You will see the record throughput of over 5 million tons with 2.3 million carats sold and $250 million of revenue from Cullinan. So very good performances we've highlighted already. Important to note is that we are looking now at and have started developing new levels below our previous CC1 East mining, which is effectively now mined out. So we're in the process of developing tunnels on the eastern side of the ore body to put in new sub-level caves to supplement the production from C-Cut on the western side of the mine. Thanks, Keith. At Finsch, as we've reported, we did have a number of issues related to waste ingress that were exacerbated by very high levels of rainfall. I'm pleased to say that the impact of the rainfall has been mitigated, and we're making very good progress around managing the waste ingress at Finsch. Having said that, we felt it was necessary to implement a re-engineering project to address the reduced margin at the operation, and we have completed the design phase and are now busy with the transition planning under the re-engineering project, and we'll be in a position to provide an update at our next market trading update in terms of progress made against that. But it is really aimed at ensuring we have a matched cost base that delivers improved margins at Finsch to ensure that it becomes a strong contributor as it has been in the past. Turning to Koffiefontein, Koffiefontein, as we've said, is a smaller operation. It's near end of life, and the re-engineering exercise there is really looking at how we get this operation to a break-even point, and we will similarly be providing an update on progress against that project at our next trading update. Williamson, as Jacques mentioned, following the board's decision to consider its strategic options at Williamson, it is being held as an asset held for sale. The mine was on care and maintenance for the full financial year 2021, and as we've mentioned, plans are in place and are currently being implemented to resume operations at Williamson. Our discussions with the government of Tanzania are continuing. We have made good progress. We're not yet in a position to be able to finalize those discussions, but they remain constructive, and we continue to look forward to resolving those as soon as possible. If I then turn to Project 2022, I think we've been talking about Project 2022 for a while. It was implemented back in the middle of calendar year 2019, with the main focus of generating additional cash to put us in a position to refinance the then $650 million bond. COVID turned that on its head, and we ended up going through the capital restructuring that we've discussed at length. Importantly, though, what we're seeing is the benefit of Project 2022, which really has instilled an operating culture of continuous improvement in the business. It's part of our operating model, and we are seeing ongoing benefit both on throughput and in terms of cost efficiencies, which pretty much are delivering what we had expected in initiating the project back in July of 2019. And then finally, just turning to the outlook, there's a summary slide on the outlook. I'm not going to take you through the detail of each of the guidance numbers for the individual operations, but at a group level, as we've indicated, 3.3 to 3.6 million carats in terms of guidance, cash costs of 267 to 293, with capex, total capex of $78 to $92 million. And then final slide in closing is really just to reflect on where we are as a business. I think we very much have stabilized our operational performance. Cullinan has been really the flagship operation in financial year 2022, has had a good start to this financial year in 2022. We have got re-engineering projects, as I mentioned, at Finsch and Koffiefontein, and we look forward to discussing those in a little more detail later at our next trading update. Project 2022, as discussed, is delivering, continues to deliver value, and is now firmly embedded in the operating model of the business. And our 3-year agreement with NUM provides us with stability in terms of our workforce relationships. The capital restructuring has given us a balance sheet that is certainly considerably more sustainable, although we will, of course, continue to monitor and manage our liquidity carefully going forward. And then to close, I think we've seen ongoing support from the market. We certainly saw a stronger turnaround than we had anticipated, and we are very pleased to see that that support is continuing. And with our improved operations, stabilized performance, a large diamond resource, we believe that we are very well positioned for this next stage in Petra's journey. Thank you very much. We will now move on to the Q&A session. And as I said, I would encourage those of you who have questions to ask to raise your hand using the hand emoji. And if you're not able to do that, if you would prefer to type in the dialogue box, we will also take those questions. There may be some of you who can't use either of those options, unfortunately, in which case we would just ask that you get in touch with our investor relations team, and we will then revert to you in addressing any questions you might have. So we're going to endeavour to take the questions in the order they're asked in terms of the raised hands, and then we will turn to the dialogue boxes if anyone has typed any questions. Right, so
first question, Richard Hatch has his hand up. Richard, your mic has been, what's the word?
Unmuted. Yeah.
Disabled or enabled rather, and you should be able to unmute.
Okay, you hear me okay?
Perfect, thank you, Richard.
Yeah, good. Right. Morning, guys. Thanks a lot for the call. Yeah, just a question on 2022 costs. I appreciate you're probably still working through these plans to get the mines kind of clear as to what you can guide the market, but would you be able to give any form of kind of steer as to what we should expect for costs as we go into 2022? I appreciate there's some moving parts there, but any kind of help would be appreciated.
Richard, morning. Jacques here. In terms of the cost guidance that we've issued last month or late July still stands. We will, as soon as we are able to, through the re-engineering project, confirm further movements on that front. We will revert back to the market on that. But for now, it's a bit too soon to still or to amend any cost guidance and to update any of the numbers that we've already.
Okay. And sorry, I should elaborate more on that. Just, are you able to give any kind of order of magnitude as to what you might be looking to target in terms of those cost reductions, or is it just a case of we have to wait for that?
I think, Richard, we've built a number of those cost reductions into our cash forecast numbers. What we haven't built in is additional targeted savings through the re-engineering projects at Finsch and Koffiefontein. So what we've reflected is that, you know, we through Project 2022, we've delivered on an annualized basis around $20 million of cost benefit. Those numbers are in the cost guidance numbers provided. So that has helped us to manage our costs and continue to manage our costs tightly. What it doesn't incorporate as yet is any further cost optimization at Finsch and Koffiefontein, which will follow on the back of the re-engineering project. So I hope that provides some clarity.
Yeah, it does. Yeah, very much so. Thanks. And then the second one's just on Tanzania. Can you just remind us what you're looking for to get a restart going? Is it agreements on VAT and the parcel? And then I just noted in the accounts there was some commentary around being unable to secure approval to proceed with a 25 million working cap facility. I mean, is that another kind of key milestone that you need to have before you push the button to restart?
Thanks, Richard. Yeah, I'll start and Jacques can come in. No, we are in the process of mobilizing around a restart. We have recalled our employees. We've been through a plant recommissioning exercise, and we're busy mobilizing mining equipment to start to move ground. So we are effectively in the process of mobilizing the restart, and it's not contingent on finalizing discussions with the government of Tanzania. We're in a position where, as a result of a $10 million VAT refund, we are able to fund the restart, and we will, continue to look at options to continue to fund the restart. So that's separate from the ongoing discussions, and that is, as I say, currently underway. I don't know, Jacques, if you want to add to that.
Yeah, just on the working capital facility of the local banks, yes, we have not yet been able to firm that up. The banks were actually suggesting that once Williamson is up and running again, that they will be amenable to further discussions. So we are likely, or will likely, approach them again once the mine is operational.
Cool. All right. Thanks for your help. All the best.
Thank you.
Thank you.
Ian, I thought I saw your hand briefly up. In the meantime, there's a question posted on the board, dividends and stock value. Can you talk about it?
Yeah, we can have a go. I think we've obviously just been through a capital restructuring. As I mentioned, I think we have a much more sustainable balance sheet. At this stage, we haven't mentioned anything about dividends simply because it's still a bit premature, fresh out of a capital restructure. But we're certainly encouraged by the cash being generated by the business, and we're mindful of where the stock price sits. We have a much healthier market capitalization following the restructure. So these are points that we will look at in terms of the board will obviously have to reflect on and form a view on dividends going forward. We obviously haven't paid dividends for some time, and I think on the share price, we'll focus on generating value for shareholders, and we will revisit the issue around share price. I know we've had questions around share consolidations, etc. We, in and of itself, we don't think that would add value, but it's certainly something that we would also and are having a look at, if that was what was behind the question. Jacques, I don't know if there's anything you want to add.
No, I think that covers it, Richard, I'm sure. Ian, I see you've got your hand up. We've enabled your mic. Thank you. You should just unmute on your side, Ian.
Can you check we've enabled him? Ian, do you want to just check that you're not muted your side? We have enabled your mic from our end.
While we try,
Ian, maybe try the dialogue box. Apologies, I don't know why it hasn't come through. So, Ian, we'll try you again. But if you're able to access the dialogue box and type your question, please do that for us.
In the meantime, Richard, I'll go over to Ollie. He's asking, can you elaborate on what you see in terms of prices and trend for the diamond market?
Yeah, I think it's very difficult for us to talk about prices, specifically. I think we've indicated, the price performance we've seen, and Jacques can talk to that on a like-for-like basis. I think what we can say is that, we are pleased with how the diamond market has responded. We've seen strong and sustained demand. You would have seen the majors in the form of De Beers and Alrosa, increasing prices steadily without there being an impact on prices. We've seen inventory come down. On the retail side, there's continued to be strong demand, particularly out of the US and China. We've seen numbers in the retail space. Signet, I think, were double their comparative period EBITDA through to July of this year. So I think we remain, I think, positive around a buoyant diamond market. We have a slightly quieter period currently as we head into the traditionally busy sort of festive period that includes Diwali, Thanksgiving, Christmas, etc. So midstream is healthy and in a much better place. They are generating healthier margins than we've seen for a while. So I think the market is generally in a good place, and we would hope to see that support continue going forward, even though we may not see the same rate of increase that we saw in the recent months.
Maybe I can just add that we are actually in the process of closing our first tender for the fiscal year 2022, outside of the special tender we held with and selling the Bluestone, of course. So we've had tremendous interest from our clients, and we should in the coming days see what the results of the tender delivered. So yeah, quite good demand across the tender. I trust that answers the question. Is it Tim Clark? We've enabled your mic. If you can unmute on your side and ask the question.
Yeah, thank you very much. I'm interested in your. I'm looking at slide 34, where you show the life of mines of the various operations, but then also the 20-year potential, the long-term potential life of mines. If you were us and you were analysts and you were modeling this, at the moment we model after 2029, 2030 when the life of mines end. We've got a certain capex profile for that. So perhaps you could clarify for us what that capex level is just for current reserve life. And then when will you be able to give us some kind of indication of how we extend those lives and what the cost will be of an extension? Because at the moment we find it very difficult to put any value on the resources.
Thanks, Tim. I'll provide a preliminary answer or a high-level answer, and Jacques can pick up from there. Yeah, Tim, I think from our side we haven't been to the market in terms of providing guidance beyond a year or two for a while, and as a result we are looking at a capital markets day early next year, which will provide a better overview of life of mine and options around life extension, etc. We currently haven't provided that information to the market, which I know is going to be a bit of a frustrating answer, but we do intend coming to the market with more detail, on this around our capital markets day, which will probably be in Feb sometime next calendar year. So, I probably can't be particularly more helpful than that right now. Jacques, I don't know if you want to add anything.
Yeah, that's going to be difficult, unfortunately, to add anything. And the potential mine life as set out in slide 34 is really an indication of the resource size at these operations, and currently does not form part of our life of mine plans, which also run to 2029, 2030. But it does reflect that there is significant opportunity across the asset portfolio. We'll obviously, in the capital markets day, as Richard suggested or mentioned, we will give further clarity on that.
Okay, and just for existing reserve life, what would you model as your? I mean, can you give us some kind of a steer as to your annual capex just for that existing reserve life, not adding any? Or, doing anything to resources? I mean, you've had a very bumpy capex number, right? It's not been very stable.
Yeah, look, I mean, in this, it's difficult to have a smooth capex number, because typically what you do, at Cullinan, for example, the C cut is a block cave, and so you invest a lot of capital up front, as you would have seen, and then your operating cost is lower over the life of the block cave. And yes, you do have some sustaining capex, so it's much easier in a block cave to be able to say, well, your sustaining capex is at a particular level. With the sub-level caves, you go through a series of developing tunnels and then mining them, and then that cycle starts again. So we've just effectively completed and are in the process of completing at Finch anyway, the current sub-level caves. at Cullinan, we aren't mining any sub-level caves. We're busy with developing the next levels. At Finch, we are mining existing sub-level cave levels, but we will start and are also spending capital there. So the capital, in terms of what we would define as expansionary, is going to be lumpy. And by expansionary, we mean capital that either adds to production or extends life. Either way, it's capital you're spending to deliver new carats, new tons of production. We can give you a sense on sustaining capex, which Jacques will give you. But I think to be helpful, it is going to require us to take you through the capital markets day, simply because we don't have this capital information beyond current guidance in the market. So again, to acknowledge it's not particularly helpful. But Jacques, maybe just to share our sort of sustaining capex high-level number.
Yeah, Tim, on the sustaining capex, a rule of thumb that's really supporting year after year is roughly 10% of our working capital, our cash online cost, approximates the sustaining capex level at the operations. Obviously, operations closer to end of life and in the existing life of mine plans, the sustaining capex level will drop off. But yeah, roughly around the 10% of OPEX level for sustaining capex specifically.
Thank you, that's helpful.
Ian, just going back to your question that you've typed up, and thank you for that. So the questions are on Williamson. With the further impairment of VAT and PPE, can you talk about the economics of restarting Williamson? And then secondly, is the $10 million VAT refund sufficient to fund the restart if working cap funding from local banks are delayed? And thirdly, when do you need to get an agreement before funding could become an issue at the mine? So Ian, maybe to start from the top, the impairments, it's really on the back of the board's decision around the strategic options around Williamson, and we had to take some views on that. So it's not necessarily an asset level type impairment around Williamson. I know that's a difficult one, but until we've clarified future steps, I think it's difficult to add significantly more to that. The $10 million VAT is sufficient to assist with the restart. There will be some assistance, and we've negotiated, in the process of negotiating, some assistance through deferred payments, etc., to some of the more material contractors on mine, which they are fully supportive of, and that together with the VAT refund should see Williamson up and running in the coming months, with the first sale to the market expected. Fairly smallish parcel, probably still being the first one after the restart, around December of this year, with then more normalized levels of sales going forward from February of next year in our normal sales cycles. And then lastly, when you need to get an agreement before funding could become an issue, the agreement with government, I assume you refer to that agreement, is, well, let's rephrase. The restart of the operation is not contingent on a successful agreement with government. Obviously, the agreement with government will add to the stability at the operation, but it's not a prerequisite to get operational and get going again on that front.
Maybe just finally to add in, the market and the state of the diamond market is really what is driving and informing the resumption of operations. We put it into care and maintenance because of where the diamond market was. Where it is currently, we obviously believe that we will generate sufficient revenue and cash to cover our operating costs and more.
Richard Hatch, I see your hand is up, and we have enabled your mic again.
Yeah, thanks. Yeah, guys, I just wanted to ask one more on Finch, actually. I mean, obviously the mine's performance has been quite poor, as you flagged over the last couple of quarters. But I just wonder as we move towards the end of this quarter, just how that mine's been performing versus plan. What grades have been kind of running at versus plan? Are you kind of seeing the improvement that you kind of hoped to have seen?
No, look, Richard, I can't say too much on it. We'll obviously say more at our next trading update. But I think generally, as I mentioned in the presentation, we've had a good start to the year. I think we're tracking well to plan, so no concerns on that front. And, the remediation underway in terms of managing the waste ingress at Finch is tracking to plan. So certainly no red flags on our side.
Cool. Thank you.
We have Robert Goodwin. I see you the next one in a row or in a line, I should say. Your mic has been enabled.
Good morning, Gareth. Thank you for coming to me. Just a question really about the future. Obviously, the business is clearly, given by its name, focused on diamond, obviously mining. But moving forward, is there consideration to sort of further operations in terms of rare earths, for example, obviously with the shift to carbon neutral and obviously the reliance on battery tech for vehicles and whatnot?
Yeah. Look, I think it's a little premature for us to be considering options outside of getting back on our feet, generating cash, and optimizing the existing portfolio. But having said that, we are in a much better position, and that does enable us to revisit and have a broader strategic conversation. And we're doing that with the board towards the end of this year. And I'm sure in those strategy conversations, we'll explore a range of options. But the short answer is currently no, we are not considering any opportunities outside of the diamond space. But we need a little bit of time to, I think, consolidate our current position, walk before we can run. And I think, we will hopefully break into a gentle jog soon.
Thank you. That's very reassuring. Thank you.
Kieran, I think you'll be the last question that we take, given the time is approaching the end of the session. So apologies, there's one more written question that we'll come back to just now after Kieran. So we've enabled your mic. Thank you, Kieran.
Hi, guys. Just a quick one on coffee, really. I guess there's quite a few of us that have been observing the story for quite some time, and obviously the coffee re-engineering story is going to be one that probably brings a cold shudder to a few of us. There's the asset has underperformed for a number of years. How are you going to give the market confidence, A, that you're going to be able to generate a material return for investors from this asset, or is it a case of the asset reducing the cost to just basically ensure that the operation doesn't bleed cash from the group because it's more expensive to close it than it is to run it at a loss? And how do you think this asset will ultimately compare to others that could offer higher value production, which is ultimately what coffee brings to Petra as a group from a return on capital perspective?
Yeah. Thanks, Kieran. Look, I think the answer is that if the re-engineering exercise doesn't demonstrate that we can generate value from Koffiefontein, we'll have to look at other options. It's as simple as that. We're not in the business, despite your very accurate observation on Koffiefontein, that of running assets that don't generate value. So this is really a step to finalize a position on Koffiefontein. And that's why we're going through the re-engineering exercise to finally determine what value we think we can get from the asset. We're also looking at a broader portfolio review, and the assets need to perform. So I can't say too much more than that, other than, of course, to add that Koffiefontein is a near end of life mine. It's an old mine. It doesn't have more than 2 or 3 years life. So you can expect us to come back with more information on Koffiefontein once we've completed that exercise. But you shouldn't expect that we would think it acceptable to run it, to continue to run it at a loss. Thanks, Kieran.
And then question from Lorenzo is the proportion of fixed and variable cost linked to current production levels, and now we expect that to evolve over time. Lorenzo, at a rounded number, our fixed cost is around 75% of our overall cost basket. If given that our going forward, we don't expect significant production increases, rather extension at some of the mines, we don't expect that proportion to significantly change over time. So around 75% fixed, 25% variable cash on mine cost.
Thank you. I think we should probably leave it there. If any of you had questions that you had wanted to ask or tried to ask but couldn't, please send them through to any of our IR team. Also give them some feedback on this as a medium and whether you found this worked or didn't work. We've tried it for the first time, and it would just be good to get some feedback. So outside of that, from our side, thank you very much for your time, for joining us, and we'll talk again in the near future. Thanks.